Good morning, everyone. Just to remind everyone that this call is being recorded. I want to welcome everyone to the Ortencio Group Spring Webinar. As always, I have with me Gareth Watson, who is our Vice President of our Investment Advice Group at Richardson GMP. Since our last presentation in January, Cyprus has been in the headlines along with gold prices. But lately, what's been dominating the news, the presses, has been the U.S. stock market. It's been continually breaking new highs, including yesterday's close. One of the questions investors are asking is this the economic recovery that we've been calling for in the U.S., or are these just investors caught in the sidelines that are trying to time the market and now want to get invested? We're really proud to say that the foundation of our investment strategy at the Ortencio Group is asset allocation, and it has worked wonderfully, not just in theory, but results have shown that it works in practice. We've been underweight bonds and overweight U.S. at the start of the year, and that's proven to be correct, the correct allocation so far in 2013. We will be reassessing the allocation as the U.S. markets continue to rise and determine if rebalancing is needed. Our closed-end strategies have also been working as anticipated. Today's presentation with Gareth, we're going to be covering areas and questions such as mentioned, the U.S. stock market. Is this increase in stock market values sustainable? How's China doing? How about Europe? What should we do about, what should we be keeping an eye out for that could affect the global markets positively or negatively? And I'll throw this out to Gareth. Are we seeing a currency war? Before I pass it over to Gareth, the Canadian, just a little bit update on what's been happening in Canada and the U.S. The Canadian housing starts cooled off in April. There was a 3.5% decline from March to April. Home builders are scaling back construction in the wake of the decline in home sales, and I think Gareth's going to touch on this a little bit in his presentation. Inflation rates in Canada and the U.S. are still in check. U.S. interest rate decisions are still going to be determined by the unemployment rate. And signs of the U.S. recovery seem to be in full stride. Fannie Mae, which is a federally sponsored mortgage association in the U.S., earned $17.2 billion in their last fiscal year, and 2/3 of those earnings will be used to pay back the U.S. government. This quarter, they booked a record profit of $8.1 billion, with reversing tax write-downs of $50.6 billion. That's an overall profit of $58.7 billion. This time last year, they had net income of $2.7 billion, so that's definitely a big increase from last year. With payments to the U.S. Treasury, the bailout cost of $188 billion is now down to $55.8 billion. So if its brother company, Freddie Mac, does the same thing, that could drop that bailout amount to $30.1 billion. So that's much needed cash injection for the U.S. Treasury. And default rates in the U.S. housing markets are at the lowest in more than 6 years. So lots of signs coming out of the U.S., positive signs. And the last one that just came out yesterday, retail sales number in the U.S. came out, and it was better than expected, much better than the decline in March. So that's a good sign considering 70% of U.S. GDP comes from personal consumption. So I'm just going to quickly review the global stock market performance. For the month of April, the TSX was down 2.3%. The S&P 500 was actually up 0.8%, and the MSCI Europe, Australia, and Far East markets were up 3.7%, and the emerging markets were down 0.6%, and these are all in Canadian dollars. The year-to-date performance for 2013, the TSX is at a paltry 0.2% return, while the S&P 500 is up 13.5%. It seems like a continuing trend over the last 3 years now, and MSCI Europe, Australia, Far East is up 10.8%, and the emerging market performance is pretty much back to where it ended for the year at 0%. So now I'm going to hand it over to Gareth to go over the presentations.
Great. Thank you, Frank. With respect to my comments today, the presentation from January is somewhat similar. It's just kind of revisiting a lot of the themes that we talked about in our outlook at the beginning of the year. And some things have changed, obviously, since January. But in some cases, there has been little change, which in some cases is a good thing and in some cases is a bad thing. The way that I'm going to approach today is, again, looking by different regions of the world. As Canadian investors, we do look predominantly to the United States, China, and to some degree Europe for economic direction. The U.S. because of our trade relationship, the Chinese because of their influence on commodity prices and our sensitivity to commodities, especially with the TSX index. And Europe, that we might not do a heck of a lot of trade with Europe, but we do care about what they're doing because China is their largest trading partner, and what impacts the Chinese impacts us. So there's all kinds of interrelationships to talk about. I'm going to start off by talking about Europe, just looking at the European 10-year sovereign bond yields. You may recall I presented this back in January, and the whole point that I had in this chart was that up until the end of 2012, 10-year bond yields were in decline. As you can see, since then, for the most part, either those yields are either lower or about the same as they were at the end of 2012. This is very a positive thing, and let me explain to you why. Essentially, the lower the bond yield is, the cheaper it is for a country to raise money. And right now, of course, the biggest problem we've had in Europe is that a lot of these countries can't balance their books. They need external financing. They go to the bond market to try and raise that money and to get liquidity. The big complications we had last year, in particular back in May, of course, were being caused by countries such as Greece, which could not balance their budgets and could not go to the market and raise money at a cheap rate. And of course, we've had some restructurings and so forth since then, which have allowed Greece to tap back into the market. But on the whole here, yields are lower, which means that the cost of financing is lower, which means that liquidity is being maintained in the system. And I think one thing that we've learned here since 2008, we can talk about fundamentals and economic statistics all we want, but if you have a market where there is very little liquidity, where money is not changing hands readily, where the access to capital at banks is not available to either individuals or corporations, that market's going to go nowhere but down. You saw that in 2008 with the U.S. financial collapse. You saw it last May in Europe with yet another blip on the radar screen from Greece. So as long as liquidity is good, markets should behave well. And in that sense, as we can see, of course, in the way that markets have behaved so far in 2013, they obviously have been pleased with the amount of liquidity that is in the marketplace because regions such as Europe, if you look at the actual stock market returns, they've been rather impressive, to say the least. Now, financing costs have improved. Financial institutions are improving their balance sheets because of that. Some of the bad debt that they had on there, such as Greek and Portuguese and Irish debt, those fundamentals have been improving. There are still a number of hurdles to overcome here, though, for Europe. They are not in the clear. Someone once told me that the euro as a currency was a solution to a problem, and now it's a problem trying to find a solution. That's a very interesting way of putting it because in order for this Eurozone of 17 countries to continue as is, there's going to be a number of fundamental changes that need to be made amongst that union. And, a key date here that we're looking at this year, September 22nd, very important. It's the German election. We believe the status quo, as most people believe, the status quo in Europe is going to be maintained up until those elections. Obviously, Angela Merkel wants to get back into office, does not want to rock the boat, does not want to annoy anyone too much. But if and when she does get back in, right now the polls would suggest that she probably would be reelected as chancellor, we could see some significant and profound changes coming after September 22nd. In other words, the gloves could come off, and we could see all types of movement within the Eurozone, which will likely, in some way, shape, or form, increase volatility in the marketplace at that time.
Can I ask a question? Garrett, what happens if, let's say, the other results occur and she is not elected?
Well, chances are it's probably going to be pitted as a pro-Euro versus anti-Euro race. So if she does not get in, chances are an anti-Euro party would have power. Again, not necessarily the case, but in all likelihood it would be that scenario. In which case I would say that the markets would not like that at all, that the markets would probably sell off, that there would be even more volatility than what there would be if Angela Merkel got into office. So I don't think it would be a very good picture because the markets do like the status quo. Admittedly, when if Merkel gets back in, there's going to have to be some type of change going on here in terms of bailouts and the way things are structured and the way the whole Eurozone as a whole operates. And the whole idea of the euro breaking up, or at least a couple countries leaving, that is not necessarily done and over with. We can't kind of file that away. It's still a possibility, but as of right now, the status quo is going to be maintained up until that election date as far as we're concerned. The Chinese situation, I have to admit, at the end of the year, we thought that they could maintain some level of status quo. It looks as though they have some level of stability in their economy. We have seen some statistics recently that would suggest perhaps the economic data is a little weaker than expected, but we're talking about, growing instead of 8%, they're growing at 7.7%. It depends on who you are and how you look at these numbers as to whether or not they're good or bad. I still think it's pretty impressive for a country of that size and magnitude to grow at such a high rate. At the same time, there are a lot of people that simply don't believe the data that comes out of China, and I think that's somewhat of a fair assessment at times in terms of the transparency that we see. But I think what probably has been a little disappointing to the market is that it was hoping that the new government that has come in would have introduced some new monetary and fiscal policy measures by now to stimulate some growth. They have not done that. They've been very conservative in their approach, and for that reason, I think that's why you've seen a sell-off I shouldn't say sell-off, but you've seen a struggle for the TSX index to move higher because a lot of commodity-related names have been held back because of the lack of activity amongst the Chinese government and central bank to take any action to stimulate trade and to stimulate that economy. Since I'm in the Asian region here, I will mention Japan because it has become far more topical recently with respect to what they're doing with their currency. And Frank asked whether or not we're in the midst of a currency war. At this point, you could say that it's not a war, but you could also say that it's not a war yet. It could become a war. And to try and explain to you what the Japanese are doing, I have to refer you to the way that people look at economic activity. And usually it is a summation of general consumption within an economy, investment in that economy, government spending, and net exports. And if you look at many countries around the world, consumption has been falling, investment has been stable or falling, government spending has definitely been plunging. So the only way you're going to actually grow an economy is by increasing your net exports, which means that you have to export more than you import. And for those of you here in Canada, you may very well remember that we had a huge trade surplus back in the 90s when our loonie was at 62 cents. In other words, Canadian goods were cheaper, obviously relative to what they are now, and were cheaper relative to other countries around the world. So we made a lot of money off of that. When you're at parity with the U.S. buck, people don't necessarily want your stuff anymore because it's more expensive than what they can get elsewhere. So what a lot of countries are trying to do right now is drive their currency lower. And the Japanese, basically what they've decided to do is really inject a ton of monetary policy into their system. They are going to be printing a lot of money, buying a lot of bonds, keeping rates low, and essentially trying to push people away from the yen and into other currencies, which therefore, of course, weakens the yen, makes the Japanese much more competitive in terms of exports. But it also tends to strengthen other currencies, which puts them at an advantage to their competitors. So this strategy sounds great as long as your competitors don't get really annoyed with what you're doing and take action themselves, which is what could be the currency war and could be actually likely is now developing into a currency war, whereby other countries will say, hey, wait a minute, you don't get to have all the good stuff. We're going to fight for as well, and we're going to try and devalue our currency. The one area of the world that is really stuck in this is Europe. They would love to have a lower euro right now to be much more competitive. But because everyone is selling off the yen and other currencies, people are not doing that to the euro necessarily, and it is actually holding in relatively well compared to other currencies around the world. So Japan is definitely a wild card in terms of whether they will be successful with their policy. But and it does hurt us here in Canada too. If people are selling the yen, then of course that means that they could potentially be buying the Canadian dollar and supporting the loonie. In fact, the loonie's held up extremely well here, considering where I thought it might be, and I'll get to that later in the presentation. Let's flip over to the United States. Frank mentioned a number of key statistics here: housing, employment. They have been improving. The Federal Reserve, to a large extent, of course, has done what it can do. It will not be raising rates anytime soon. We have seen a bit of calm in Washington, D.C., mainly because the Republicans are in big trouble, and they are trying to fix their party here nice and quietly. And in order to do that, of course, they have to remain quiet and not raise too many issues before we get to the next congressional election, which is about a year and a half away. With that said, even though we are seeing economic recovery, albeit slowly, there still are some major structural issues that probably will have to be addressed at some point in the next 5 years, namely, for example, Social Security and healthcare. But I think President Obama, he's in a good position. He doesn't need to win another election, so he's probably not going to even address those issues in the next 4 years, which is a bit of a shame because those entitlement problems are likely going to become very problematic down the road here. Now, with respect to those statistics that Frank mentioned, we have jobs being created, admittedly not at the rate we would like to see, but they are still being created nonetheless. They lost 8.75 million jobs during the recession. They probably gained back about 5.5 million of those by now, which is way behind where a country or the United States would be in its normal recovery pattern. But again, we're coming out of a recession that was caused by massive structural issues of the financial collapse. Those issues are still being fixed, and we're still working on them. Now, the housing market, with respect to the Case-Shiller Home Price Index here, as you can see, home prices have been increasing year over year as of late. That is a positive sign. If you can see a resurgence in the housing market, that could be a big wild card for the U.S. economy this year, because if housing starts to increase, that's going to kickstart a lot of other industries and create jobs, which in the long run, of course, is good for America. On the monetary policy front, we're not expecting to see any changes in rates. There's no change in that whatsoever from January, and I don't think I'll be changing that view for a very long time. The Fed did introduce a 6.5% unemployment rate as a trigger to raise rates. I have no idea why they did this. They've really cornered themselves here, because if you get to 6.5% unemployment, the economy still isn't that great. Well, you said you were going to raise rates, and you could end up really messing up this recovery. So I have no idea why Ben Bernanke has brought the old Phillips curve back into the equation here. But our point being is that rates will be lower for longer in the United States. Lots of people are targeting mid-2015 for the next rate increase. There are even some people out there that think it could be 2016, 2017, just because the Fed will not want to raise rates when the government debt levels have been going up to such an extent that the United States could obviously be paying way more of every dollar of revenue coming in towards interest payments alone, something that we as Canadians are very familiar with back in the early 90s, when 40% of every dollar that came in tax revenue to Canada went just to pay the interest on the debt. Speaking of Canada, the situation here, I would say, is reasonable. I wouldn't say it's spectacular. I wouldn't say it's great. We have outperformed in other countries here for years, economically speaking, and in terms of reducing our deficit. We're the only, I believe, G7 country that is reducing their deficit. But at the same time, it's not a home run that Canada's economy is going to continue to grow like gangbusters. In fact, it's not going to happen unless we have the Americans on board. And of course, it would help also if the Chinese were on board with respect to particularly Western provinces, which have obviously grown on the back of that resource boom last decade. With that said, we are still creating jobs, perhaps now at a slower pace than we were previously. And with respect to interest rates, we do have a new governor of the Bank of Canada who likely will not change policy direction whatsoever of the Bank of Canada. Inflation is very benign in this country, and we don't necessarily see rates go up. We definitely are not seeing them go up in 2013. Do they go up in 2014? Probably, but I'd even now bias that towards mid to latter part of 2014 than earlier in the year. So for those people wondering, are lower rates here for longer in Canada? Yes, for the remainder of this year. Now, I've always mentioned in my presentations, and I always just like to highlight it over and over again, the threat to the Canadian economy. We always sometimes pat ourselves on the back a bit too much, and we forget to talk about where the risks are. Well, for me, it is consumer debt. We have to watch this simply because when rates go higher, there are going to be some people in this country that are caught completely off guard because they don't understand the impact of a 1% increase in interest rates on their own personal lending. To be clear, a 1% interest rate increase does not mean that your interest costs go up 1%. They go up way more than that. Some Canadians don't have a firm grasp of that concept, and they are the ones that will be caught short when rates do go higher. But obviously, a lot of Canadians have had access to cheap money. They've been getting it, and they've been spending it. We have to make sure that they're in a position whereby they can pay that back going forward. So that's going to be the risk going into 2014, but not in 2013. Same thing with respect to the real estate situation. People wonder, are prices about to collapse this year? My answer is I don't believe so. In terms of downward pressure, that doesn't happen until rates go higher, which again we don't expect until next year. On the commodity front, just briefly, I wanted to give you an idea here. It's been a Jekyll and Hyde year, a good year last year for commodity prices, not so good this year. Just to go over a few areas, oil and gas. We thought oil could range between $80 to $100 a barrel this year. So far, it has been towards the upper end of that range. Considering the outlook for the global economy, I would not be surprised to see oil prices come down below the $90 level in the near term, unless we get a pickup in the global economic recovery. If the status quo is maintained, I think I could see oil prices pulling back a bit here, just simply because the demand is not necessarily as strong as, let's say, $95 oil would suggest. With that said, I actually kind of am hoping that we could see some lower oil prices, because that will only help the global economic recovery. The lower your input costs to that economy, the easier it is for that economy to grow. With respect to natural gas, I'll be blunt with you. I've been completely wrong on nat gas this year. We didn't have much good to say about it at the beginning of 2013, and yet it is one of the better performing commodities thus far. One of the main reasons for that was likely that we had a colder winter, and definitely, for those of you in eastern Canada, and actually in western Canada as well, you'll notice that we had a much colder spring than normal. That likely put some upward demand on natural gas prices for heating, especially in the U.S. Northeast and in the eastern parts of Canada. With that said, I'm not really changing my view on natural gas. I still think we have way too much of it. The supply is outstripping demand. If we have a normal summer, you could easily see those inventories continue to climb, and therefore I'm not backing the rally that we've had in natural gas at this stage. Base and precious metals, they have been disappointing. They have fallen because the China story has not been as strong as people would like it to be. But with that said, still 7.7% growth in China, I still think is a positive for base metals, just in terms of commodities themselves. And I still think that there is some support to be gained in things such as copper, nickel, and zinc. On the gold front, we definitely changed our view at the beginning of the year. We were no longer bullish on gold. We were becoming concerned that quantitative easing and monetary programs in the States were going to either just not increase or be reduced. That trade, we think, has been what's driving gold prices for the past couple of years for gold denominated in U.S. dollars, and we've seen the end result of that with a very large pullback in gold so far in 2013. Is this a temporary blip? Are we headed back to $1,900 an ounce? My answer is no, we are not. Yes, some other parts of the world may still be printing money, but in terms of this 10-year bull market cycle, we definitely think that we're closer to the end of that cycle than the beginning. And for that reason, I mean, yes, there's likely some short-term trading opportunities to be made in gold if you can time the market perfectly, but longer term, we are certainly still less bullish like we were at the beginning of the year. On agriculture, this is very dependent on weather, always will be, always has been, and I do not have my degree in meteorology, but I can tell you that the beginning of the year we were more bullish because the moisture levels in the Midwest, where a lot of these crops are grown, was still quite dry. We went through a drought last year. It was terrible. It kind of lasted through the winter. The Mississippi levels were getting to the point where even barges couldn't flow down it. But then we had a large amount of moisture come in, large amounts of rain and snow, and the moisture levels have improved. Grain prices have pulled back as a result. But longer term, we are still very supportive and bullish on the agricultural industry in Canada and globally. So the TSX index, being a commodity-related index, naturally has pulled back as commodities have pulled back. We've had a nice bounce here as, well, not necessarily in the back of rebounding commodity prices, but as investors continue to push higher yielding stocks up. People are still looking for income, and they likely will continue to be looking for income for a very long time, which supports defensive industries and utilities, telecommunications, consumer staples, and so forth. The TSX index will not outperform U.S. indices this year. I think that is clear. Can we break above break even? I think we can still finish higher for the Canadian index in 2013, but you have to temper your expectations. You're definitely probably looking at returns that will be hopefully higher single digits, but probably not into the double digits. And then finally here on the Canadian dollar, our view at the beginning of the year was that the U.S. dollar was going to see a resurgence of support, that the U.S. dollar was going to outperform the Canadian dollar. At the same time, we didn't think that would cause the Canadian dollar to plunge. We thought it would hold in reasonably well, and that you would find the loonie somewhere between, let's say, 95 cents to $1 in 2013. For the most part, that's happened. It's probably been a little bit closer to parity than to 95 over that time frame. There are some calls now that it's supposed to plunge to 90. I don't buy into those arguments unless we see a significant decline here in oil and gold prices for the remainder of 2013, in which case 90 cents is potentially on the table. But I'm not expecting that scenario to materialize. I think people's expectations going forward is for a loonie that is just below parity. And the volatility, for the most part, hasn't been too huge. We haven't seen massive dips or gains, again, staying within a pretty tight range of 96 to 99 cents for most of 2013, and that's probably where we're going to stay for the rest of the year. With that, I will turn things back to Frank.
Thanks, Gareth. So one question is, what would you like to see coming out of the U.S. and out of Europe to have this, stock market rally continue to go on?
Well, the actual rally has been, I think, driven less by fundamentals and more by a lot of this monetary policy action, especially in Japan. Because what it is doing, it's driving rates and it's causing investors to look at their portfolios in terms of the returns that they're going to get out of it. And it's making them realize in some cases with lower yields and with lower returns, they're going to have to look elsewhere. And they've been looking towards equities that have provided them with a decent dividend yield. And if you look, for example, the TSX index, we might be break even, and you've seen a bit of a recovery here. That hasn't necessarily been on the back of commodity stocks. It has been probably more on the back of traditionally interest-sensitive stocks. There's been some lift from commodities, don't get me wrong, but the driving force here hasn't been this huge resurgence back into commodity prices. It's been people looking for yield. The same thing, I think, can be said on the United States. A lot of these indices are higher because people have been going after these more defensive names. Japanese investors are going to be getting less and less for their money. So for a country which has traditionally invested within their borders, there's lots of discussion at how a lot of money is going to leave Japan and go into other countries trying to find that yield that they're not getting in their homeland. So these flow of funds kind of issues, I think, has been what's been driving the market higher. The fact that central banks are active, that they are trying to do something, is good. But that's only one part of the equation. There has to be fiscal reform. There has to be structural reform. In a lot of these countries, that's the type of stuff that's going to take years to correct. So this isn't an issue that we can simply sweep under the rug by buying a whole bunch of bonds. QE does not fix a lot of the problems. It just basically gives us a bit of medicine and allows us to try and fix them, or gives us a bit more time to try and fix the problems that we're facing. So on the whole, I would say that this rally, it is very sensitive to the accessibility to money and to the flow of money within the marketplace. And right now, central banks have been doing a good job of flooding those markets with cash.
And one more question or topic here is there opportunities here on the cyclical side of things, the stocks or growth stocks, as we'll call it at this point, with the defensive stocks doing so well?
Yeah, no, it's a great question, and my answer to that is short term, not so much, but longer term, probably yes, because eventually this cycle is going to turn. I wish I knew the exact date. If I did, I probably actually wouldn't be here. I'd be making way too much money and retired. But at some point, you are going to see the global economy turn. Now, there's some that will say, hey, that's not happening for 3 or 4 years. There are some that will say, hey, it's actually going to happen next year. If you can get the Europeans out of recession this year, which I still think is possible, but definitely is being complicated by the fact that the euro is not falling as much as people want. If the Europeans can start seeing some signs of life, that's only going to help the Chinese. And if the Europeans and the Chinese together are doing better 6 months from now, 12 months from now, I think that only then bodes well for the Americans. So it's one of those things, it's a domino effect, and it's a huge effort to try and get that first domino down. Right now, the United States is running on its own. For the global recovery to be truly meaningful, we're going to have to see a number of other countries follow suit.
Okay, great. So to summarize the presentation, the U.S. growth rate is going to be now, at a slower pace. We hope that Merkel is reelected back in September in Germany to control the volatility out there, and Canada, we anticipate, should the economy is doing well, and the stock market, there's a bit of a disconnect there, but it's driven by the commodity side, and hopefully we'll get high single digits on the performance of the Toronto Stock Exchange. And overall, I think it's as we had anticipated at the beginning of the year, we definitely felt more comfortable going into 2013 than we did in 2012, and the first 4 months has shown that at this point.
Yeah, I'd agree with that. Yeah.
So at this point, I'd like to thank everyone for joining us, and thank Gareth again for joining us today. And this will be available for replay, and if you want to forward it to friends and family, we would encourage you to do that. Thank you for joining us, and please look out for some of the information that we sent out on a regular basis. Thank you.